Right, hello everybody. Welcome to today's live podcast. This is Adrian here. It's the 18th of November 2019. We're going to be talking about the record highs in the stock market today and all sorts of other weird and wonderful stuff that's affecting the currency markets, the stock markets, the commodity markets. I'm here with my CEO, Jerry Miller.
Hello.
And Jerry's back from Nepal, actually. He came back over the weekend where he was climbing up to base camp. A bit of a distraction, Joe, but how did you get on?
Pretty good, actually. Sort of got a few croaky voice effects, but that's probably largely sitting on an aeroplane for 14 hours. But no, all good. Glad to be back. Get back in the hot seat.
A good mindful experience, probably, was it?
Mindful and physical experience, yeah. Something else. But, yeah, all good.
Good, excellent. Well, let's get on with it. I'm sure people don't want to hear about that. So, what about the markets then, Jerry? I know you've been a little bit out of the loop, but are we going to talk about the calendar? We're going to talk about trade war today. So, do you want to kick us off?
Yeah, well, record highs. US markets, extraordinary. I mean, when I left, I thought, I wonder if this is going to run out of steam pretty quickly. But here we are. What is it, the 18th?
Yeah.
Friday. We had more positive news that propelled the market side. So this is the S&P. It's just extraordinary. I don't know. You can come up with lots of reasons, positive data, but I think the main US-China trade war or some sort of resolution to it. I think this chap, Larry Kudlow, Trump's economic advisor, said that the negotiations were sort of on a phase one of a trade pact were close to agreement, and I think that's what kicked it off on Friday. But yeah, the market's been quite optimistic about that for some time, hasn't it?
It has, and it seems to be the topic that keeps coming back every sort of few days, doesn't it, and impacting the markets.
Yeah, I think the S&P was up sort of nearly 1% Friday. That's its third consecutive record close, and the Dow Jones. I know we're not looking at the Dow Jones, which is a bit of a weird market that's price weighted, but that went through the 28,000 level. It's just extraordinary.
Quite psychological, these round numbers as well, aren't they?
Yeah, they are. But I mean, I left for Nepal and we were sort of close to the 27,000 level. And here we are a couple of weeks later and we're up another 1,000 points. And, I thought the 27,000 was psychological, but the 28,000 before long will be at 30,000.
And I suppose weirdly, with the US economy, it's really been slowing. Interest rates have been cut to bolster it, and yet equities are at record highs.
Yeah, I know. That's it's sometimes quite difficult to reconcile when you look at what's going on. You think, well, hang on a second, data's not so good. They're having to cut interest rates because the economy is slowing. Trump was quite vociferous about that. He's pushed the Federal Reserve slightly. They're supposed not to be interfered with, as it were, but they've cut interest rates 3 times in as many meetings. It doesn't sort of sound like the economy is doing well, and yet the stock market, which represents the economy, is doing well. Mm. But of course, I can answer that very simply by saying that stock markets have a habit of looking a lot further forward than you and I would with current events. So it's predicting positive news. And also that ruddy argument, Tina, there is no alternative. Where else do you put your money?
Yeah.
You can't.
Yeah, absolutely. And what about the impact on the stock market in the UK? So we're talking about the US being going to record highs.
Yeah.
Are we putting money into the UK stock market right now?
Golly.
Or is it that there's no alternative than the US stock market?
No, there is no alternative. Well, the German market's doing pretty good, but no, the UK markets, we all know what's going on here now. It's we're in this sort of state of purdah, as it were, with the UK general election on the 12th of December. So we're sort of going to be reacting to everything going on there, but there's little investment coming into the UK markets, as you'd expect, because there's massive amounts of uncertainty.
Yeah, there's one thing the market likes, it's certainty. Either way, I mean, we've seen that with breaks over the last 3 years, for goodness sake.
Yeah, we've had enough.
You just want to know, don't you? And then you can react accordingly, can't you? I mean, we had a nice little sell trade on the FTSE just last week, actually, which went on and hit target on those Friday lows before the US market, I guess, pushed the UK market back up a little bit. So we do follow a touch, but we are definitely out of sync with the US right now.
Yeah. I mean, the shape of our chart looks nothing like the US indices, whether it be the Dow or the S&P, or indeed the DAX. But, I mean, even with the positive news that we've seen over the weekend, I was looking recently, Adrian, at the spread bet markets, the political betting market, as it were, and there are companies that will make you a market in the number of seats that each party is going to get. And whilst I was away, in fact, I think it was sort of this time last week.
I think it was Monday. It was literally quarter of an hour before we launched the podcast. At 12:15 that Farage came out with his announcement. Yeah.
And that announcement being that he wasn't going to contest 347 seats or whatever it was that the Tories were going to get.
Yeah.
And immediately the spread bet markets pushed up the number of seats that the Tories are expected to get to 343 at 352. So that's the bid offer spread. Let's say it's 343. That effectively, okay, the way this works, a majority in the UK Parliament is 326. Yeah?
Yeah.
But without Sinn Féin, they never vote. Mm-hmm. And without the Speaker's vote, it's 320. So you've now got a potential majority. Now you've got to work this one out carefully. It's not 23, it's 46.
Of course,
because the others are not going to get it.
Yeah.
So you effectively double it, which would be a good outcome if you were a Tory. So you just need a majority of more than 320 seats, really. Is 46 a decent majority? It would be. It's something that Theresa May had no luxury of. But you might say, well, the markets, why aren't they buoyant on the back of that? And you can look at sterling. Sterling bounced a little bit. But I just say this is the 18th of November.
Yeah, we've
got this 12th of December. Yeah. You've got this televised debate tomorrow, and there's another one on the 29th, and then another one on the 6th of December. I think we've got a long way to go. Anyone trying to make up their mind about what's going to happen with this election today or tomorrow is really running a big risk, I would suggest.
So to ask questions such as, would the pound be more positive over Corbyn or Johnson, or what is it going to mean for the stock market? It's probably a little premature to sort of look at that, is it?
Yeah, I would say so, unless it was just such an obvious shoe-in. I think the likelihood of Labour getting in power is pretty minimal. But the question is not Labour, it's whether the Tories manage to secure some sort of workable majority. And until we get closer to it, let's face it, the polling institutions have not had a good record.
No.
When you look at what happened with the Brexit referendum, when you look at what happened with Trump and the presidential election, just the track record's not good. So there you go.
Yeah. Okay. Certainly, it would seem. I mean, that the pound certainly rallied dramatically on Monday last week when Farage came out with his statement. So it would seem that level of perhaps more certainty over a Johnson government or Conservatives winning with a majority would be positive for the pound. But yeah, let's just I see how we get on. It's certainly been rallying this week, and the odds have shortened a lot on the Conservative. I think it went from 7 to 1 on for a Conservative majority, and I think it's now something like 20 to 1 on.
Yeah, and I'm not surprised. I think it's 50 to 1 against on Labour. But as I say, these things ebb and flow, and I'm reluctant to be too positive about anything really. But I would say a Tory government would be a lot more favourable to the markets than a Labour government. The numbers that are quoted by the Labour Party in terms of their policies are just mind-boggling and, quite frankly, nuts. And I think that's why it's reflected in the spread bet market with the number of seats that the Tories and the Labour Party are potentially going to achieve. So, but as I said, long time to go. A positive outcome is a Tory victory. A negative outcome for the markets is a Labour victory, or indeed a hung Parliament, of course.
Well, yeah.
Then we're back to square one as well.
That's good for me. Okay, so what about the European markets then? So German markets seem strong. So why has that been?
That's interesting you mention that, actually, because just put up the German
the DAX,
market. The DAX. There, you just compress it a bit. It almost looks like the Dow or the S&Ps, doesn't it?
Yeah.
And here we are discussing the German market, where we had a negative GDP the previous quarter. Germany just scraped in with a positive GDP last week, a plus 0.1%. You just click on that, that's it. So it's German GDP there, yeah. So there we go. A recession or a technical recession, the description of a recession is where an economy shrinks for 2 consecutive quarters. So this data from last week on Thursday actually confounded expectations and came out at plus 0.1%. I was a bit surprised by that.
We were expecting a fall of 0.1, although being preliminary, struggling to say that word, are we saying that this could be revised and we could end up still negative potentially? It'd be quite a big difference, wouldn't it? But
it could be, and I was a bit surprised because a lot of the data that was coming out over the last quarter was really negative.
Yeah.
So it's possible it could be revised, but it is only a technical recession. Going back to the chart, going back to Charting Centre, just having a look at where we are with the DAX, you'd think, hang on a second, the German economy has had, I mean, if you look at some of the data on the manufacturing, and this is something that's coming out this week, Adrian. Look, there's German manufacturing data. Just look at this. This is the collapse in manufacturing PMI data.
That's horrendous, isn't it?
And then to look at the charts and think, well, hang on a second, is that the same economy represented by the DAX is suffering all these woes? Well, this is down to the trade war again. So we're sort of almost in the same discussion that we are with regards to the FTSE, with the Dow and the S&P. Why is that going higher? Well, optimism about the US-China trade war, and that's what's caused the big problems in Germany to a large extent. It's collapse in export orders to the Far East and China.
I mean, it's interesting when you compare, because we've got quite a lot of this manufacturing PMI and service PMI later on this week, haven't we? So you've got the European overall is down. So Germany, large proportion of that, obviously.
Yeah, exactly. That's right.
Whereas the US, okay, it's not as high as it had been, but it's certainly not in that below 50 territory yet, is it? And that's the important level, the 50, isn't it?
That's right. The way the Purchasing Managers Index works is that it's a survey of all the purchasing managers, and if you've got a positive component above 50, it means more than half the managers are reporting a positive outlook rather than a negative outlook. So if the number is higher than 50, it's positive. So you can contrast the US expectation at 51.5 compared to the Eurozone at 46.4, which is which is that number there. So there is a significant difference there. The Eurozone is beset by a lot of structural problems that the US is not beset by. But I'm just amazed at the way the DAX has climbed, almost blinkered in a way, in following the US markets and the optimism about a trade deal. What you've got to remember as well is when and if these trade deals are sorted out between China and the US, what's the US going to go next? It's the European auto sector. So it's like the next thing that happens for Germany is that particular.
That could be a bit painful for them, couldn't it?
Yeah, that's a New Year present for someone.
Yeah. So okay, so interest rates, 3 cuts in however many meetings. What about going forward? What's are we likely to have any more? What have we got? One more meeting this year?
Yeah, exactly. I was thinking about it earlier on, and I was sort of suggesting that there will be no more cuts this year. But of course, there's only one more meeting, and we've got something called the FOMC minutes in the middle of this week, which is the minutes from the rate setting committee of the Federal Reserve, the US Central Bank. It's called the FOMC, the Federal Open Market Committee. They've actually cut rates 3 times in as many meetings. And the rates are currently at 1.5 to 1 3/4, or you'll notice on this chart here it says 150 to 175. That's in something called basis points, but just to say the current rate targeted by the Federal Reserve is 1.5 to 1 3/4, and it ain't going to change in December. And the reason why it's not going to change is I think the Fed made it very clear in the last meeting that they would like to see what the effect is of these 3 cuts. It's too quick just to keep on cutting. They want to now wait a period of time and just to see what effects it's had. And it almost seems like the stock market is happy with that. It's like, we've had our 3 cuts. Thank you, Mr. Powell. Thank you, Federal Open Market Committee. Let's move on. Let's get the trade deal done, and then we can really go for it.
It's interesting. I mean, it's only a modest difference, really. But this time last Monday, we had a very quick look at this, and I think it was down at about 5 or 6% chance of a cut. but now it's sort of flicked ever so slightly really the other way, although it's small differences. I suppose it's not really meaningful, is it?
No, it's not. Anything more than 80% is a bit of a shoo-in, really. And I mean, things could happen. There could be a massive stock market collapse through God knows what, but I don't see that happening, in which case the Federal Reserve will definitely sit on its hands, and we'll be looking at this in the new year for further cuts.
So, all right, so look, we've got a couple of bits into the end of the year. We've got Thanksgiving, we've got Black Friday, Cyber Monday, Christmas, a few stocks in the US coming up with their results. So what are these seasonal factors, do you think, that might help or affect equities?
You know, it's really interesting. So you mentioned Thanksgiving, Black Friday, Cyber Monday. So that all happens, well, next Thursday is Thanksgiving.
It's unusually late, isn't it, this year?
Yeah, it's the last Thursday, so it can be that way, but it certainly is late this year, which basically means Cyber Monday. Is Cyber Monday?
The first Monday of December, so the 2nd of December.
Okay, yeah. So Cyber Monday is the Monday following Black Friday. Black Friday, weirdly, the name, people used to say it comes from the number of cars on the roads or whatever, but Black Friday refers to the fact that in the olden days, pre the internet, was when retailers went into the black, i.e. were trading positively. So come the, Thanksgiving, that's when they paid off all their costs, then the profits roll in for the next sort of 4 or 5 weeks to the end of the year.
Yeah.
Anyway, it's an important event. A lot of retailers are very focused at this time of the year. In the run-up to Christmas, a lot of retailers generate sort of 30 to 35% of their turnover. So, and you can imagine how important that is.
We've actually got a few retailers coming out this week, haven't we?
Yeah, we have. Actually.
Target, Macy's.
Yeah, sort of. If you
Home
think
Depot, by the way.
Depot. I think they call it. We don't call it Depot, but they do. So Target, Macy's, Home Depot,
Foot Locker,
Nordstrom, Victoria's Secret. There you go.
Yeah, it's a lot of
right. So a lot of them coming out, and they're doing better. A lot of, even JCPenney, who was a company that was struggling, has reported slightly better results. Still a loss, but it just goes to show you how consumer sentiment is a lot more positive when the stock markets rally. Everyone looks at their 401ks, their pension accounts, and when they're on their highest.
Positive, yeah.
Yeah. It's a very positive sort of mood at the moment. But, not always the case. Remember what happened to December last year?
Well, should we very quickly look at that? Let's have a look at the S&Ps. We'll talk to you about why I look at the S&Ps and not the Dow in a second, but where are we?
Yeah.
Yeah, so this is October coming into November, nice little rally into the end of November, and collapse. Big collapse. And of course, it's funny because a lot of people talk about a Santa rally or a Christmas rally, which has become this thing where people start talking about it in mid-November, but actually, historically, it's like the few days before Christmas, isn't it? Or between Christmas and New Year, isn't it?
Well, actually, it literally is 2 or 3 days before Christmas.
Yeah.
But for some reason, the press get hold of it and they call a Santa rally, on the 3rd or 4th of December. It's complete nonsense.
Yeah.
It's when the markets are very thin, when a lot of people are on holiday, and people only take, Christmas Day, Christmas Eve, Boxing Day off. They don't take all the days off before Christmas, and it's just then that the markets tend to get pushed up in anticipation for all the new money that comes in the new year.
I think in the States, typically they only get about 10 days statutory holiday a year, something like that, compared to our 20.
Yeah, and they get more bank holidays though, or state holidays, so they benefit that way. But yeah, the average worker kicks off with 2 paid for holidays weeks a year, which is quite tough.
Yeah. Okay, so well, look, one of the things we wanted to talk about was a bit of a follow-on from what we're talking about today is about the stock market, the US stock market at record highs, and sort of where do we go from here? We talked about the VIX last week. Did anyone find it? Let me know in the chat, guys. Did you find it useful last week? We talked about the VIX. We talked about the sort of the sentiment side of that. Let's have a quick recap of that. We've seen the US market. Let me just quickly bring the S&Ps up and say it continues to rise. We've actually now, if I just zoom in a little bit there, we've actually seen the VIX as from Friday actually go below that sort of not exactly a magic 12 number, be a bit over egging it there, but it has now gone below 12, the low of 11.92. The lows that we talked about, or the big selling moves, the big downward moves on the stock market, have all started from the VIX having been below 12. Last week, we hit a low of just below, exactly 12 dead on, 12.00. We've actually gone below that 12 number now. So that's getting us into a more interesting zone now for the VIX. Definitely, it's hit something that's been comparable with other big falls. Are we going to get one just yet? I don't know. It's really hard to say. We certainly seem in the right zone as far as the VIX is concerned. Of course, you've got to look at the context of trade wars and so on. But it has been a crucial level in the past. We're at that level right now. I guess sometimes you need a catalyst for something that's going to affect these. What? I don't know.
Do you know, I was thinking that as you were talking, I was sort of thinking, well, what unexpected event could come along? And of course, the fact is, it's unexpected, so we're not going to talk about it.
We don't know, do we?
And
the irony is, it's often good news that ends up topping out the market, which is weird.
Well, this is something that we often sort of argue over, as it were. You know, what happens when they make an announcement about this phase one of a trade deal?
Yeah.
What happens then? And if there is, and I sort of said, I guess it depends what's said following the announcement, i.e., and now we're going to move on to phase two, and that's going to be this, that, and the other. But it's all a bit of a game of chess, isn't it, between the two, China and the US? And I think it's possible that we could have a bit of a buy on rumor, sell on fact reaction. And that's, just for those of you who are not too sure what that means, it's basically the market anticipates all the good news of a trade agreement or a phase one of a trade agreement, hence the big move in the market up. And then you get the announcement. It's like, oh, now what? And that's when you get the profit taking. And that's why, paradoxically, the market will rally in anticipation. But when it gets the news, when everyone else thinks, hey, the news is positive, let me buy the market, they can't understand what's coming off.
Yeah, the idea being, I suppose, if you've got a trade deal effectively done and that's deemed as positive, as you move to phase two, what's likely to happen? Well, it either carries on going, which we already know about, or
it corrects.
The rails could come off and all of a sudden there is no trade deal.
Yeah, it'll come
so
off
the risk is the downside.
I would say, and it's not something I'd like to, how can I say, plan for. I'd prefer to be looking at an opportunity to get long of it again. Because I think the mood is sort of generally positive. And again, we talked about seasonality. This is the time when you want to start looking at getting long of the market, especially into the new year.
It seems like a pullback followed by a move to, probably new highs, especially with the old team, I think we talked about earlier. But who knows? Let's not think too many chess moves ahead, shall we?
And it sounds too obvious to me as well.
It probably does. The other thing is client sentiment as well, and this is not something we've talked about too much, but the sentiment of traders, which way the traders are positioned, is also interesting as well. The contrarian view for that one. If I look at the markets.com platform here, it gives us a view of which way traders are positioned. Is anyone familiar with this? Looking at client sentiment, you can give me a quick yes or a no in the questions box. That would be great. So one of the benefits of attending the live session, 92% of markets clients are bearish. The Dow, the US 30 at the moment. Only 8% are bullish. What does that mean? Well, okay, this signal shows you how our active traders are trading an asset. A stronger bear percentage means more traders are selling, while a stronger bull percentage means more traders are buying. This means that traders at the moment are overwhelmingly bearish on the stock market, and yet the stock market continues to climb. So what does that mean? Why is this interesting? It's interesting because historically, if you watch what people are doing here, that can give us an indication of timing as to when this market might actually fall. And that usually is when all those bears suddenly flip to bulls, and that's usually the time at which the market's then going to come down. And it's that sort of contrarian view, because typically what traders want to do is short a market just because it's gone up, and we typically want to be in quick, we want to be in first, we want to be the cleverest person and get in on the highs, whereas actually usually we're better off waiting for that turning point, waiting for the more clearer opportunity really to come through. Is anyone familiar with that? Does that all make sense? let us know in the questions box. I mean, certainly I've seen this time and time again where people are typically bearish way into a run-up, and then what happens is, of course, particularly when you see a move like we've seen with the S&Ps, let me just bring the S&Ps up, you get to a point where, and let me just get back to the start, like we saw at the end of last week, everyone's bearish, 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 bearish. What's going to stop people from being bearish? Well, they might get stopped out of their shorts. That's going to mean they're buying. The number of people that are placing sell orders is then going to reduce because people then don't believe the market's going to go down anymore. Everyone's panicking out of their short positions, which means they're buying the market back again to close their trades out, maybe even going long because they think, God, they can't take this pain any longer, and they're just going to have to go with the path of least resistance, which is currently up. Whereas actually, that's usually the time when sentiment flips, and that's the time to short sell.
It's quite interesting when you actually talk to retail clients and you hear the words like expensive, overdone, and words like that. But what's expensive? What's expensive at the beginning of November or the beginning of October is now cheap. Yeah. So it's all this relative term where traders decide that something looks too pricey, so that they then become almost counter-trend traders.
Yeah.
And that's why charts are useful, because this tells you that the majority of traders and investors and asset managers, they're buying the market.
Yeah.
It's not going down. There are more people buying it.
And actually, if you look at certainly the UK is slightly different, but yields out there, dividend yields out there are still positive, still attractive. Particularly against bond markets. There's still good money to be made on income, dividends, and value in the stock market. So as long as that remains the case.
Yeah, I mean, it's always interesting, of course, what happens when stock markets go up, bond markets come down, and the yield goes up. So there's a tipping point, but. Yeah. I think the results in this last quarter have been quite positive. They always beat expectations because they downgrade their own expectations. But the yield on the 10-year bond in the States at 1.86, something like that. So it's bounced a lot, but it's still not encouraging enough for people to get out of equities into bonds.
Yeah. People
want to know that the future is positive, not just now. What is the story for next year?
Yeah.
What's going to carry on? And obviously, US-China trade war. Any big negatives in phase 2, assuming phase 1 gets done, phase 2, it seems like that's all unraveled. The stock market will miss a beat.
Yeah.
But that's not yet, and we've got to wait for phase 1 to be agreed first.
Yeah. Okay, we've got a few minutes. I just want to go through a little bit of theory, if you don't mind, and don't all log off, please. So it's interesting. I mentioned earlier how I wanted to bring up the S&Ps rather than the Dow. Does anyone understand the difference between the Dow and the S&P, or any of the differences between the Dow and the S&Ps? And you can pop that into the questions box now, please, guys, if you know of any differences that are there. One obvious one is that the Dow is made up of just 30 stocks, whereas the S&P 500 is made up of, as the name would suggest, 500 stocks. So the S&P is a much broader index, and yet, weirdly, we were discussing this earlier, is that when you hear it in commentary talking about the US stock market rising or falling, market commentators would typically talk about the Dow, and yet it's only about 30 stocks, whereas really the S&Ps is the much more relevant index, to be honest with you. The other thing that's a bit sort of weird is that they're calculated very, very differently. You have effectively two main ways of calculating indices. The Dow is something called a price-weighted index. And what that means is that the movement in the price of the Dow is based on the movement on the price on the stocks. That makes sense. But the more the stock moves in price, the bigger the price, the more dollar it moves, the more it affects it. And again, I'm sort of saying this like that's an obvious thing as well. What I mean by that is this. Let me explain. It's probably better if I show something on here or demonstrate whilst I'm showing something. Okay, a $1 move on any stock on the Dow 30 will move the Dow by about 6 points, okay? What that means is we've got Apple at the top here. Apple's currently trading at about 265 bucks a share. So if that moves from 265 to 266 bucks a share, that'll move the Dow by about 6 points, okay? That's useful to know. But look below that, American Express. That's at $120 a share. So let's call it half the price of Apple. What does that mean? It means, again, that if that moves up $1, that will also move the Dow by 6 points. However, the difference being is that in percentage terms, American Express has to move twice as fast as Apple in order to have that 6-point move. Does that make sense? So a $1 move on Apple is around about, what, a 0.4% move.
It's more than double for Amex.
Whereas Amex needs to move more than double that in order to have the same impact on the Dow. All that basically means is the stocks that have the biggest impact on the movement of the Dow are the ones that have the highest share price. The size of the company, the size of the number of employees, the market share, anything like that is absolutely irrelevant. It's all based on the size of the price. The higher the price, the bigger impact it's likely to have, all other things being equal based on that $1 move. This is why you'll see that the Dow 30, which is not based on the biggest 30 stocks in the US like a lot of people think it is, and actually I read on one broker's platform that's how they defined it as the biggest 30. It's not. It's based on it's elected by a panel.
That's right, yeah, from the Standard & Poor's organization.
And there's two very big, what you would think would be components that are not in the Dow. Let's have a look at the S&Ps very quickly. One of which being Amazon, which has got a $1,740 price, and also Alphabet or Google, which has got a $1,300 price there. The reason for that is that they would just have a huge distortion to that, because a $1 move on a $1,700 stock is nothing. It'll happen all day long. Every sort of 3 seconds it's probably doing it. That's a bit of an exaggeration. But the point being, it would distort the value or the price movement of the Dow too much. So those shares are not included in the Dow 30 components. Does this all make sense? You still with me? Hopefully not. No one's too bored to tears just yet. Okay. So how is that relevant? It just means that they can move in a slightly different way. The S&Ps, by contrast, is not based on its price. It's based on the market capitalization. Jerry, what does market cap mean?
Basically, it's what the company's worth. It's the number of shares issued times by the price. And it is an anachronism. I might have missaid something a second ago when I said it was the S&P. It's the Dow Jones Corporation that decides the components of the Dow Jones. The Standard & Poor's 500, that's what everyone references, because that is the sum of all the companies valued, the top 500 companies by market cap, by value.
Yeah.
And the irony is that news organizations, BBC, ITV, CNN, the first thing they quote is the Dow Jones.
Yeah.
It's very old school.
Yeah.
But we still reference it. And I've been in the business 36 years, and that's what continues to happen.
Weird.
Yes,
yeah.
I know.
So the difference between the Dow and the S&Ps is that the S&Ps is calculated based on what's called market cap, so the size of the company. As you might think, and it makes sense for this, the companies that have the biggest in size are the ones that have the biggest impact on the index movement. You can't have a company that's worth, whatever Microsoft's worth, have the same impact on movement or a lower impact on movement just because the share price is higher, or just because, it's just another company. If you compare this, a movement in, say, Microsoft, it has a weighting of 4.4% of the S&Ps. So the S&P movement is drastically affected by Microsoft because it is the biggest component, and Apple as well.
And that's what's interesting about that. The first and second, Apple has got the same impact, but the price is a lot higher than Microsoft. And the price is irrelevant. Because we were talking about that earlier, Adrian. Apple have had so many stock splits. So the share price, it should be above 1,000. Can you imagine putting that in the Dow? And it is in the Dow, but it wouldn't be.
It's weird because in the States, they don't usually like doing stock splits. In fact, it's quite unusual. I mean, in fact, you've got a company like Berkshire Hathaway. I mean, this is their B-class shares. Yeah. But their A-class shares are $359,000 or something a share.
You'd struggle to buy one share.
Yeah, that's right. But actually, it's interesting because in the US, the reason why they don't like stock splits, which then dilute the sort of the price of the share, is because there's a number of reasons. Number one, there seems to be this sort of bravado almost in having the highest share price. The higher the share price means that generally the better the company is doing. It's like a badge of honor. And by having a stock split to reduce the price, people don't think it sounds as good. Also in the US, rather than like the UK when we get charged commissions based on percentages, in the US they're charged based on cents per share. So obviously the higher the price of the stock, realistically the lower the number of the shares that you're going to buy. So if you're buying less shares, it's going to cost you less money in commissions as well. So that's important, which means that it's going to be more actively traded, more actively invested. Berkshire Hathaway, by contrast, you know, they don't really want people trading their shares.
They want investors.
They want investors, longer-term investors that's going to hold the price to a reasonable level. So it's quite an interesting concept. But what's interesting with Microsoft here is that you've got this having a weighting of 4.4%. If I go to the bottom here, the lowly 500th company, which is News Corp here, which is still, you know, a bit of a beast, that has an impact of 0.006%. That's the weighting that it makes up of the S&P 500. So just to be clear, Microsoft is 733 times bigger in market cap than News Corporation. And as you might expect, because of the size of it, it has a much bigger impact on the movement on the S&Ps. Whereas in price terms, it is quite different, but it may not necessarily be so. In fact, you've got Alliance data there at $104 a share. If that was in the Dow, that would have a similar movement to what, JP Morgan at 129.
Correct, or Johnson & Johnson.
In fact, it would have a bigger movement than ExxonMobil.
Yeah, which is nuts.
Yeah.
But that's the way it operates. And you will get days when the news organisations might report the Dow being up 100 points when in fact the broad index is down.
Yeah.
And everyone's thinking, well, hang on, how can that be? What's wrong with the S&P 500? There's nothing wrong with the S&P 500. That actually represents corporate America. The Dow Jones, an anachronism in a way.
Yeah. So that's it really. I don't know if that's interesting or not. I certainly think it's relatively interesting, but perhaps that says more about me than anything else.
You little bookworm.
Guys, that's going to be it from us for today. So hopefully that's been a useful session. And remember, if you'd like to know more about terms of identifying the trading opportunities, some of the opportunities we've been talking about today, then what you can do is tune into one of our live trading events. You can go to trend-signal.com and you can register on there on the right-hand side to register for an upcoming live webinar event. So get yourself booked in. But if you would like also if you're watching the recording, but you would like to register for the live, this is how you can ask questions during the live sessions. You should find somewhere, or just email us in at info@trend-signal.com and we can get you booked in to attend the live sessions as well. If you're in the live one, of course, you've already done that. So that's great. That's it for me, guys. Have a wonderful week's trading. We'll be back with you next week, of course, next Monday. It'll be Jerry and I again. You're not climbing any more mountains?
No, I'm done for a while.
Good. All right, then, guys. All the best and catch you soon.
Cheers.